Bad day for Skype and Zoom, but I'm glad we're connected, Scott.
All right,
good to see you.
It's been a minute, too, so it's good to see you. I'm glad you're back with us at this particular time in the markets, too. Why don't you bring us up to date on your current view of the markets? As I said, it's been a while since we've heard from you, so I'd love to hear it.
Well, listen, I think you guys have covered it well. It's a period, as Stan Druckenmiller said last week, of peak uncertainty. We were here a year ago, and we basically said interest rates are near zero. They need to normalize, which means going back to 2.5% or 3%. Multiples were very high because interest rates were low. Those needed to normalize. And here we are a year forward, and they've largely normalized. But the world now is really scared that inflation is stickier than we thought, that rates need to go higher than we thought. So if you look at now what the market is forecasting, even though the one-year break even on inflation is 2.4%, we're still talking about a 75 basis point increase, followed by a 75 basis point increase, followed by a 25. And the market's forecasting that we peak out somewhere around 4.4 in March. And now we have this tension. Larry Summers is saying we're not going fast enough. We need to do another 100 basis points. And Gundlach and Sternlicht this morning are saying, hold on a second here. There's a lag effect. The economy's slowing way faster than you think. Elon was tweeting about the deflation he's seen yesterday. And so I think the risk has shifted to the Fed perhaps over-tightening, right? The economy has proven incredibly resilient. The market, frankly, I think is pricing things fairly. But now we're at this moment where we're looking to see, can the Fed get inflation under control to their satisfaction without rates having to go to 5 or 6%? So that's our view of the world, that you need to have intellectual humility. If you need to make money over the next 90 days, it's a pretty treacherous place to be. But if you want to find great companies that you can compound in over the next 3 to 5 years, we think this is a very fair place to enter those names compared to last fall, that we all know the multiples were quite high.
So if you're worried about the risk of a Fed over-tightening, or as you referenced, a Gundlach suggesting to me out in California of the Fed, in his words, oversteering, what's most interesting, I think, is that you told our producers in the conversations ahead of the show, you've been covering your shorts. So your positioning suggests that you see some decent entry opportunities either here or coming up?
Listen, we've had massive volatility over the course of the last 5 months. It's a lot of up, a lot of down, and a lot of sideways movement at the end of the day. So, yes, we saw opportunities when companies like Snowflake were trading at $115, $120 a share not long before earnings. We saw opportunities to cover some of our shorts that were down 60, 70%. But we're talking about the ballast here. We take 10 to 15% of our book and we say, listen, when the market is overshooting and panicking and the VIX is spiking, we're going to take off some of those shorts. We're going to add tactically to some of our longs. And on the other side, when we think the market is getting ahead of its skis, the S&P was not long ago at 4,300. We were selling some protection. So, that's a way that we're trying to, move around this volatility. We're not making wholesale moves. You can look at our 13F. Our largest position continues to be Snowflake. And so, but that's a tactical way for us to manage exposure around this moment of peak uncertainty.